Friends, thank you for being here today. Let us begin by addressing the market paradox that is confusing everyone, a phenomenon that defies traditional logic and leaves even seasoned analysts scratching their heads. Have you ever stopped to truly analyze the current state of the financial world and asked yourself the most pressing question of our time? What if I told you that the market has not crashed simply because it is not allowed to crash yet? And could it be that the very delay you find comforting is actually the most dangerous part of the trap? When you look at the raw data, when you study the historical precedents, and when you observe the fundamental laws of economics, the market today should have already collapsed into pieces. The signals are flashing red, the consumer is stretched to the breaking point, and the geopolitical landscape is fracturing. Yet the market has not collapsed. In fact, it continues to climb higher, breaking records and defying gravity. The prevailing narrative suggests that the economy is resilient, that innovation is driving growth, and that we are in a new paradigm where the old rules no longer apply. However, the truth is far more complex and far more unsettling. There are specific reasons for this anomaly, reasons that most people are entirely unaware of, and reasons that the major banks and financial institutions would prefer you did not understand. Because once you peel back the layers of this financial onion, you begin to see the game with crystal clarity. You begin to see that the system is not broken. Rather, it is functioning exactly as it was designed to function. To understand why the stock market is still standing, we must first look at why it should have already fallen, then examine the artificial pillars holding it up, and finally understand the mechanics of the inevitable controlled demolition that awaits. Let us start by examining the economic paradox that defines this era, the massive disconnect between reality and valuation. We are currently witnessing what many observers are calling the everything bubble. In 2008, the world economy was brought to its knees by a bubble primarily concentrated in the housing market. Today, however, the distortion is not limited to a single sector. It has metastasized across the entire financial spectrum. The stock market is rising so fast that it has divorced itself from the economic reality on the ground. Over the last 5 years alone, the stock market has increased by nearly 100%, a rate of growth that historically signals an overheating engine. But the true danger lies in the valuation metrics that are currently screaming warnings that are being ignored. If we look strictly at the mathematics of the market, the case for a crash is not just strong, it is overwhelming. Consider the favorite valuation measure of the legendary investor Warren Buffett. This metric, often called the Buffett Indicator, compares the total value of the stock market to the size of the entire economy. Specifically, it divides the total market capitalization of all public companies by the gross domestic product (GDP) of the United States. Historically, this ratio acts as a thermometer for the market's health. When the result is 100%, the market is considered fairly valued. Anything significantly above 100% suggests the market is overvalued and due for a correction. To put our current situation into perspective, let us look back at the year 1999. This was the height of the dot-com bubble, a time of extreme speculation and irrational exuberance. At that peak, just before the bubble burst and the market collapsed by more than 60%, the Buffett Indicator stood at 115%. That figure was considered dangerously high at the time. Today, however, the numbers are in a different stratosphere completely. Currently, the total market capitalization of United States public companies hovers around $66 trillion, while the GDP is approximately $30 trillion. When you divide 66 by 30, you do not get 115%. You get a result of over 216%, and in some calculations, it approaches 220%. This is nearly double the valuation level that preceded the massive crash of the year 2000. If you only looked at this single data point, logic would dictate that the market should already be in ruins. The absurdity continues when we examine the price-to-earnings PE ratio. This metric measures how much investors are willing to pay for every $1 of earnings a company generates. For normal, healthy companies in a stable economy, investors usually trade at a ratio of 15 or 20. This means paying $15 or $20 for $1 of profit. Technology companies, due to their growth potential, sometimes trade higher, perhaps at 25. Today, the average PE ratio for the S&P 500 is hovering between 25 and 28, which is already historically high. However, the average hides the terrifying reality of the top companies that are driving the market's growth. NVIDIA, a darling of the current tech boom, has seen ratios ranging between 53 and 55. Amazon and Microsoft are trading between 35 and 40. But the most shocking outlier is Tesla, which has seen a PE ratio reaching 286. To understand how irrational this is, imagine buying a small local business. Would you pay nearly $300 for a business that only pays you back $1 a year? It would take 3 centuries just to earn your initial investment back, assuming zero growth. It makes no financial sense. It is akin to paying $66 for a hamburger that should cost just $1. Yet investors keep buying, driven by a fear of missing out and a belief that prices will only go up. Now we must look at the fundamental flaws and ask why the system should have already collapsed. Beyond the stratospheric valuations of the stock market, the fundamental engine of the American economy, the consumer, is running on fumes. In the United States, consumer spending makes up roughly 70% of the gross domestic product. For the market to be truly healthy, the consumer must be financially healthy. But the data tells a story of desperation, not wealth. Personal savings rates are near record lows, having been depleted by years of relentless inflation. Meanwhile, credit card balances are at record highs. Americans are not spending money because they are wealthy. They are spending money they do not have. They are drowning in debt to maintain a lifestyle that their wages can no longer support. The inflation tax has eroded purchasing power to the point where essentials, groceries, rent, gas, and insurance premiums consume the vast majority of the average worker's paycheck. The labor market, often touted by the media as strong, is showing cracks. It has become a lagging indicator. Hiring has slowed significantly and layoffs are creeping upward. The no hire, no fire phase is ending. When consumers finally hit the wall, when the credit cards are maxed out and the savings are gone, spending will stop. When spending stops, corporate earnings fall. And when earnings fall, the market, which is currently priced for perfection, faces a reckoning. Furthermore, we must look at the reality of corporate earnings themselves. Investors in the media often look at nominal numbers, the actual dollar amount of revenue a company reports, but they rarely adjust for the value of the currency itself. Consider this scenario: if a company sells a product for $100 today and earns a $10 profit, its earnings are 10. Now imagine inflation spikes and the government debases the currency. The price of that same product rises to $200. The company's profit might double to $20 even if they did not sell a single extra unit. To the algorithm and the headline reading investor, it looks like the company is growing. Earnings have doubled. But in reality, the company has not innovated. The currency has simply lost value. Much of the growth we see today is merely inflation disguised as prosperity. If the indicators are so dire, why has the collapse not arrived? We must now turn our attention to the artificial pillars, the forces propping up the market. The answer lies in the fact that the free market is no longer free. It is being propped up by 3 massive artificial forces that are distorting reality: government spending, currency devaluation, and corporate stock buybacks. The first and perhaps most powerful force is unprecedented government spending. The United States government has ceased to be merely a participant in the economy. It has become its life support system. Every year, the government collects approximately $5 trillion in tax revenue. However, it spends roughly $7 trillion. This means the government is overspending by at least $2 trillion annually. This is a deficit of staggering proportions, yet it is treated as business as usual. This borrowed money does not simply disappear into a vacuum. It flows through the economy. It pays for defense contracts, social programs, healthcare, and interest on the debt. It ends up in the hands of corporations and individuals who then spend it. This massive injection of liquidity creates an artificial floor for the economy. It boosts corporate earnings artificially. When the government pumps $2 trillion of borrowed money into the system, it finds its way into the revenues of the companies listed on the stock market. So the real question is not why the market has not crashed, but how long the government can sustain overspending by such a massive amount to keep the illusion alive. With a national debt exceeding $38 trillion and annual interest costs topping $1 trillion, the mathematics of this scheme are becoming impossible. The second force holding up the market is inflation itself, specifically the devaluation of the dollar. This is a concept that requires a shift in perspective. Investors are not just betting on the productivity of companies, they are betting on the devaluation of the dollar. They know that as the government prints more money to fund its deficits, the value of each individual dollar goes down. Consequently, the price of assets like stocks, real estate, and gold must go up to compensate. The stock market's rise is in many ways a reflection of the dollar's fall. It is a silent, ongoing bet on inflation. Cash is trash in this environment. If you hold cash, you are guaranteed to lose purchasing power. Therefore, capital is forced into the stock market as a defensive mechanism. Furthermore, inflation is the best friend of the debtor, and Wall Street is the biggest debtor of all. Hedge funds and the ultra-wealthy operate on massive leverage. If you borrow millions of dollars today to buy stocks and inflation rages on, you get to pay back that debt years later with dollars that are worth significantly less than when you borrowed them. Meanwhile, the assets you bought with that debt have risen in price due to the same inflation. It is a double win for the wealthy. Their debt becomes cheaper, and their assets become more valuable. This dynamic encourages massive speculation and keeps the market elevated far beyond rational levels. Perhaps the most insidious force propping up valuations is the mechanic of stock buybacks. In 2025 alone, companies have spent approximately $1 trillion repurchasing their own shares. This is a staggering increase from 20 years ago, when buybacks totaled only about $168 billion. What is a stock buyback? It is when a company takes its profits, or worse, borrows money, and instead of investing in new factories, research and development (R&D), or higher wages for employees, it uses that cash to buy its own shares from the open market and retires them. This reduces the total number of shares available. By reducing the supply of shares, the company artificially inflates the earnings per share (EPS). Even if the company's total profit stays flat, the profit per share goes up simply because there are fewer shares. This creates artificial demand and drives the stock price higher. Why do they do this? It benefits the shareholders by avoiding dividend taxes, but more importantly, it benefits the CEOs and executives. Most modern executive compensation is tied to stock performance. If the stock price hits a certain target, the CEO receives a massive bonus. Therefore, management is incentivized to use company cash to engineer a higher stock price rather than to build a better business. Apple alone spent $100 billion on buybacks this year. Alphabet spent $70 billion. NVIDIA spent $60 billion. They are using their cash piles to act as the buyer of first resort for their own stock, creating a floor price that defies natural market dynamics. I want to pause here and ask you a question because this affects every single one of us. Do you believe this level of manipulation, where companies prop up their own stock prices instead of investing in the economy, is sustainable? Or are we just setting ourselves up for a disaster worse than 2008? I want to hear your thoughts on this, so please leave a comment below. Beyond these broad economic forces, we must expose the specific mechanics of manipulation within the financial plumbing itself. While government spending and inflation provide the macroeconomic fuel, the actual structure of the financial system has been rigged to facilitate this wealth transfer. The mechanics of the modern market are far removed from the romanticized idea of a bustling floor where buyers and sellers meet to find a fair price. We must look closely at quantitative easing QE. This term is thrown around in financial news as a complex monetary tool used to stabilize the economy. In reality, it is the most elegant wealth transfer system ever created. When the Federal Reserve announces it will engage in quantitative easing, it is saying it will buy Treasury bonds to inject money into the system. But it does not do this in secret. It telegraphs exactly when and how much it will buy. This gives the major banks advance notice. Knowing the Federal Reserve is about to enter the market with billions of dollars in buying power, the banks purchase these securities at current market prices. Then when the Federal Reserve executes its promise and drives up demand, prices rise. The banks then sell their holdings back to the Federal Reserve at this inflated cost. The profit is essentially guaranteed because the buyer, the seller, and the timeline are all known in advance. If private citizens coordinated trades this way, it would be called insider trading, and people would go to prison. When the central bank does it with commercial banks, it is called monetary policy. This newly created money flows directly into the financial markets, inflating asset prices that only the wealthy can afford to own. Furthermore, the market is manipulated by mechanisms that most retail investors do not even know exist. Dark pools and high-frequency trading. Dark pools are private exchanges where institutional investors can trade massive blocks of shares away from the public eye. Over 50 of these private exchanges operate in the United States, processing nearly half of all equity trades. The name is not metaphorical. These are literally dark markets where price discovery happens away from public scrutiny. This allows large institutions to manipulate prices, coordinate strategies, and execute trades without alerting the public market until it is too late. Combined with this is high-frequency trading, HFT. Sophisticated algorithms execute thousands of trades per second, holding positions for mere milliseconds to extract fractions of a penny from every transaction. These systems do not invest in companies. They skim money from the market. They front-run orders, meaning they see a retail investor's order coming, buy the stock milliseconds before the order hits, and sell it to the investor at a slightly higher price. It is a tax on the public executed at the speed of light. Then there is the concept of too big to fail, which has evolved into a moral hazard that underpins the entire system. We saw this clearly in the collapse of Silicon Valley Bank in March of 2023. When the bank failed due to poor risk management, the response from regulators was swift. Within hours, it was announced that all deposits would be guaranteed, even those above the legal insurance limits. The message was clear. If you are connected to the right networks, the rules of capitalism do not apply to you. In a true free market, failure is a necessary cleansing mechanism. Bad businesses must fail so that good ones can rise. But in our managed system, systemic risk is not tolerated when it threatens the wealth preservation networks of the elite. Losses are socialized and transferred to the taxpayer or the currency holder, while gains remain privatized. But to understand the motive behind this, we need to look at the geopolitical and global context. Why is the United States government engaging in such reckless spending and market manipulation? Why run deficits of $2 trillion a year? To answer this, we must look beyond economics to geopolitics. Since 1945, the United States has created and controlled the world order. It was the industrial leader, the financial leader, and the military leader. The United States dollar became the world reserve currency, giving America an exorbitant privilege. If you wanted to trade globally, you used dollars. This created a permanent demand for United States currency and debt, allowing the country to borrow cheaply. However, that dominance is currently under its most serious threat in decades. Countries like China, India, Russia, and others, often referred to as the BRICS nations, are rising. They are building their own financial systems, their own technological stacks, and their own military capabilities. They are actively trading in currencies other than the dollar, a process known as de-dollarization. This shift threatens America's position at the top of the pyramid. If demand for the dollar collapses globally, the trillions of dollars held overseas will come flooding back to the United States, causing hyperinflation. Therefore, the United States has made a strategic choice: spend as much as necessary to subsidize the economy, fund the military, and maintain technological superiority, even if it means borrowing from the future. The government believes that by overspending now and pushing trillions into the system, it can outspend its rivals and maintain hegemony until the dust settles. This is why the deficit is $2 trillion. It is a defense budget disguised as an economic budget. But the cost of this defense is the devaluation of the currency. Foreign nations are buying fewer United States treasuries because they no longer view them as risk-free assets. This forces the Federal Reserve to step in as the buyer of last resort, further expanding the money supply and fueling the asset bubbles we see in the stock market. To truly understand why the crash has not yet occurred, we must also shine a light on the dark corners of the banking system that the media refuses to illuminate. I am referring to the invisible fracture known as the commercial real estate (CRE) time bomb and the shadow banking crisis. While the S&P 500 hits record highs, the foundation of the American banking system, commercial real estate is rotting from the inside out, and the silence surrounding this reality is deafening. Consider the landscape of our major cities. The shift to remote work has left office towers across the country standing like hollow monuments to a bygone era. Vacancy rates in major metropolitan areas have skyrocketed to levels never seen before. In a normal market, this would trigger a repricing event. Building values would plummet to reflect their lack of income. But this is not a normal market. These buildings were purchased or refinanced during the era of zero interest rate policy with loans that are now coming due. In 2024 and 2025 alone, over $1.5 trillion on commercial real estate debt is maturing. These property owners are facing a refinancing wall where they must replace 3% loans with 8% loans, all while their buildings sit half empty and generate half the revenue. Mathematically, these properties are insolvent. If they were marked to their true market value today, a massive percentage of the U.S. banking sector, specifically the regional banks that hold nearly 70% of this debt, would be instantly wiped out. So why haven't they collapsed? Why haven't you seen the headlines? Because of a policy known in the industry as extend and pretend. Regulators and the Federal Reserve are quietly allowing banks to modify these loans, extending the maturity dates and pretending the underlying collateral is still worth what it was in 2019. They are engaging in accounting alchemy, allowing banks to value these toxic assets at their book value rather than their market value. If they were forced to acknowledge the true price, the capital reserves of hundreds of banks would evaporate overnight, triggering a crisis that would dwarf 2008. Furthermore, we are witnessing the rise of shadow banking, private credit, and private equity firms stepping in to buy these bad debts or lend where banks cannot. This moves the risk from the regulated banking sector into the opaque world of private funds, where there is zero transparency. The risk hasn't disappeared. It has simply been hidden in the shadows. This is why the crash hasn't happened yet. The authorities have built a dam to hold back the floodwaters of insolvency. But the water level is rising every single day. They are using liquidity facilities like the Bank Term Funding Program to plug the leaks, effectively printing money to cover the losses of failed risk management. This entire sector is a zombie walking dead, but kept upright by regulatory forbearance and liquidity injections. It is the ultimate delaying tactic, buying time at the expense of currency stability. They are terrified that if one domino falls, the entire chain reaction will begin. So they have chosen to freeze the market, suspending reality in the hopes that interest rates will magically drop before the bills come due. But hope is not a strategy, and this wall of debt is the detonator waiting for a spark. This leads us to the most critical question regarding the psychology of the crash. Why is there a delay? What is the anatomy of the coming crash? If the system is rigged to go up, will it ever crash? The answer is yes. But it helps to understand the psychology and the timing of how these crashes occur. Crashes do not happen simply when economic conditions get bad. If that were the case, the market would have collapsed a long time ago. Crashes happen when confidence breaks. Think of confidence like a bridge that is carrying too much weight. It does not collapse when the first crack appears. It collapses when the final bolt snaps. We can identify a sequence of 3 phases that precede every major collapse, and we are currently deep within this cycle. Phase 1 is irrational exuberance, where we are right now. Markets stay high for longer than anyone thinks is rational. People are frustrated because the market feels completely disconnected from reality. Bears and skeptics are mocked. This phase creates a sense of invincibility among bulls. Phase 2 is crash fatigue. Investors become numb to bad news. We hear about inflation, corporate layoffs, and earnings warnings, and the collective reaction is a shrug. The sentiment is, whatever the market says, the Fed will save us. Bad news stops moving the markets. This is classic pre-crash behavior. It is the calm before the storm, where the market drifts upward on low volume, sleepwalking toward the cliff. Phase 3 is the snap. A confidence-breaking event hits. It is not always the obvious threat. It is often something small, a surprise bankruptcy of a seemingly stable company, a credit event in a corner of the banking sector, or a sudden liquidity freeze. That single event triggers a chain reaction. The algorithms switch from buy to sell. The leverage that drove the market up unwinds rapidly, forcing selling at any price. Panic spreads, and the crash that everyone expected months or years ago finally arrives all at once. Why has it not happened yet? Because the delay is strategic. The timing of the crash is not purely economic. It is political and strategic. The crash will come when the cost of propping up the market finally exceeds the benefits of doing so. It will come when the smart money, the insiders, the politicians, the bank executives have finished positioning themselves. We see signs of this preparation. Even Warren Buffett is currently sitting on a record pile of cash, selling major positions in banks and tech companies. He is not buying at these levels. He is selling. He knows the game. He knows that when the correction comes, it will be brutal, and he is preparing to use that moment to buy assets at a discount, just as he has done in every previous cycle. The delay allows the insiders to exit the burning building while telling the retail investors to enjoy the warmth of the fire. The greatest danger for the individual investor right now is normalcy bias. This is the psychological state where people believe that things will continue to function the way they always have, because that is all they have ever known. We assume that because the market bounced back in 2008 and 2020, it will bounce back again. We assume the dollar will always be king. But history is littered with the ruins of empires whose citizens thought the good times would last forever. From Rome to Weimar, Germany, the pattern of debasement followed by collapse is undeniable. The delay in the crash is enticing people to become complacent. It is luring the last bit of safe capital into the risky market. It is convincing the average person that the fire alarm is false. But make no mistake, the smoke is real, and the exits are being quietly locked. If this breakdown is helping you see through the fog and understand the true risks we are facing, please take a moment to hit the like button and subscribe to the channel. Your support is crucial in helping us spread this message and wake more people up to the reality of the situation. And finally, we must ask ourselves, what is the societal cost of this rigged game? The consequences of this rigged system are not just abstract numbers on a screen. They are felt in the bone marrow of society. The result is a K-shaped trajectory where the wealthy zoom upward and everyone else spirals down. This creates massive wealth inequality. As previously noted, the top 10% of Americans own almost 90% of the stock market. The bottom 90% own almost nothing in comparison. So as the dollar loses value and stocks climb higher, the rich get richer. They do not feel the pain of inflation because their assets are inflating faster than their cost of living. For the bottom 90%, the people who earn wages rather than capital gains, the reality is brutal. Their wages might rise slightly, but they do not rise at the same pace as the cost of living. Their groceries, their rent, their gas, and their insurance premiums all become significantly more expensive. This is the inflation tax. It is a transfer of purchasing power from the poor and middle class to the holders of assets. The wealth gap stretches wider and wider. The system forces ordinary people into a participation trap. Savers are punished. If you keep your money in a savings account, you lose purchasing power every year due to inflation. Therefore, average people are forced to gamble in the stock market just to try and preserve their wealth. They are forced to participate in the very casino that is rigged against them, buying stocks at record high valuations because cash is trash. But there is a darker dimension to this controlled demolition theory that we must consider. If the current system is destined to fail, what comes next? Many experts believe that the crash is being delayed not just to protect wealth, but to prepare the infrastructure for a new monetary system. This is where the concept of central bank digital currencies, CBDCs, enters the picture. In a crisis of sufficient magnitude, when the dollar is collapsing, when banks are failing, and when panic is absolute, the government will offer a solution. They will likely introduce a programmable digital currency as the savior of the system. They will say it is safe, efficient, and necessary to stabilize the economy. But unlike cash, which gives you freedom and privacy, this new system will give the central planners total control over how, when, and where you can spend your money. The crash, therefore, may not be an accident. It may be the necessary prerequisite to usher in this new order. This is known as the Hegelian dialectic problem reaction solution. The authorities create or allow the problem, the financial collapse. The public reacts with fear and demands safety. The authorities then offer the solution, a new tightly controlled financial system that they had planned all along. This explains why the bubble is being allowed to inflate to such dangerous proportions. The bigger the bubble, the bigger the crisis, and the bigger the crisis, the more radical the changes the public will accept. So where does this leave us in the end? The stock market has not crashed yet because it is being artificially sustained by a combination of reckless government overspending, deliberate dollar devaluation, and a financial structure designed to concentrate wealth at the top. It is a system that relies on the ignorance of the majority to fund the prosperity of the minority. The delay we are experiencing is not a sign of safety, it is a sign of danger. The longer the natural forces of the market are suppressed, the more violent the eventual snapback to reality will be. We are watching a controlled demolition in slow motion. The charges have been set, the structure is weakening, and the countdown has begun. The system is not broken. It is working exactly as intended for those holding the remote control. The crash is not canceled. It is merely cued. The question is not if it will happen, but when the orchestrators decide to let gravity take its course. When that day comes, the illusion of paper wealth will evaporate, leaving behind only the hard reality of real value. Understanding this rigged game is the only way to ensure that when the dust settles, you are not the one buried under the rubble. The choice to see the truth is now yours.